term sheet is important because it is the first kind of commercial handshake that you have between the investor and the founders. It is important in a sense that we don't want surprises later on.
We are paying 4 million for 20% stake in the company. So the founder assumes that I own 80%. And then the first term sheet comes and he's like, I own only 70%. This 10% is ESOP and you guys are owning 20%. Where is this 10%? Why are we not equal?
The more complex the company's business is, the more regulated it is, the more older the company is, that much time your LDD and FDD are going to take. So typically we see something between 60 to 120 days for funding.
So the trend that we have been seeing is that term sheets are becoming shorter. So it is usually anywhere between 2 to 3 pages where you cover the key terms. Liquidation preference in a sense is a downside protection. End of the day, the investor is a financial investor and they would want some kind of downside protection, especially at the early stage where the company and the product has not been fully built out. Good negotiation is one where both parties feel that they have lost something. I think you are a pro.
Start. Hello everyone. Welcome to another episode of No BS by Elevation, where we help young founders navigate the complex world of venture. In the first episode, we talked about crafting the best pitch deck to communicate your story to the investors. Hoping that episode was helpful for you and hoping that you have now convinced the investors to fund you. Now we'll move on to the second step, which is when you sign a term sheet along with the investor. It'll be an interesting episode where we talk about the details of the term sheet, any questions that young founders might have had, and any nitty-gritties, negotiations, etc. that we focus on the term sheet. And for that, today I have with me Ram and Shweta from the legal team here at Elevation. Thank you so much, Ram and Shweta, for taking out the time. So to start things off, I think the first question, just to set the context for everybody, is what exactly is this term sheet? How long is it usually? Is it really that important? Because it seems like a bridge document, right? You sign it, it's applicable for some days, and then you anyway sign the SHA, SSA, and all those legal docs. Maybe we'll cover that at some later episode. But term sheet, is it really that important? What all is included in that term sheet?
Right. So I can go first, Vaibhav. Term sheet is important because it is the first kind of commercial handshake that you have between the investor and the founders. So whatever are your key commercial terms are usually contained in the term sheet. Plus it contains a brief overview or a brief high-level principle of whatever are the legal terms that you would expect in the long docs. So coming to your question as to why a term sheet when we are anyway going to enter into longer docs. So it is important for both the founder and the investor to align on what should be the broad overview of terms that they enter into when they enter into this handshake. So initially, while you will have Vaibhav negotiate with the founders and convince them that both he will convince the founders and they will convince that this is the right fit for both the Elevation and the company, there would be certain terms apart from the high level or headline valuation item that we need to cover or we need to consider. So while the term sheet per se is non-binding, it is important in a sense that we don't want surprises later on where both the founders and the investors have spent time, effort and have entered into this relationship without understanding what they want to do at a later point of time. So for example, at Elevation, our term sheets or the documents that we have are very standard or not unusual in some sense from whatever is generally followed in the Indian venture capital industry. Whereas some other funds which may not have done so many deals in India or which may have their own peculiar requirements may want some unusual terms or unusual deal structure may be required by them. So from that sense, for a founder also to get into that right perspective with the investor, it is important that we agree on a term sheet.
Understood. So it is like a very brief document on which you negotiate so that we have already paid the lawyers to draft the SHA, and if there we negotiate and fall back, it is so expensive. Much rather do whatever negotiation we want at this stage itself.
Right. So the trend that we have been seeing is that term sheets are becoming shorter and typically again, our fund or Elevation follows a very simple term sheet, which is also similar to most of the leading VCs which we see in India. So it is usually anywhere between 2 to 3 pages where you cover the key terms, and it is not required to have a very elaborate term sheet as long as you cover the key commercial terms and the key legal terms that you would enter into long docs. It is also important in a sense because you also have an exclusivity obligation where both the founder and the investors shake hands saying that for the next 60 days or 90 days they will mutually engage exclusively with each other.
Yeah. Understood. I can imagine, back in the earlier days, this was done on a napkin, paper napkin that I have signed with you and I'll be exclusive with you, let's do the valuation, etc. That has kind of evolved into this structured framework, which we can call a term sheet maybe.
Right.
Interesting. Okay, now that we know what is the basic premise of a term sheet and why it is important, and for this podcast, let's focus on early stage founders. First institutional round, probably seed or even pre-seed. The founder has so many things on his head, right? He's just crafted the right pitch deck. He's just agreed to, raising money from, let's say, Elevation, and then a term sheet has come. It's although only 2 or 3 pages, but there are some clauses there, right? And I've had the privilege to look at a few term sheets. There are some details there, various different types of clauses around valuation, board, etc., etc. What will be interesting is what are these main headers inside a term sheet and what are the most important for a founder to negotiate? Because see, at that time, the most important for the founder is time. And not all of these will be equally important for him to negotiate on, right? Him or her to negotiate on. So if you can just talk through a little about what are the most important clauses, maybe we can dive deeper into each of them. And if in your advice, these are the top 2-3 which should be the most important for the founder to negotiate, what would those be?
So actually taking from what Ramanuj said, right, what your term sheet does, it's a blueprint, right? So you don't want to build the entire building, but you want to have a blueprint at the term sheet stage, right? So usually you'll see 3 sets of rights which are good to have, or usually you would see in term sheets, right? First would be your economic. Works for both founders and the investor, right? These would be rights like your valuation, your liquidation preference, your exit. All of these protect value of the company, ensure that the investor's investment is also not suffering. So that is the point of, economic rights. Second would be your governance or control related. Those are usually, board composition, affirmative vote matters, things like that, which decide who is making decisions in the company and what is their decision-making authority. The third would be your ancillary clauses like, governing law in a term sheet, something as important as exclusivity. So, this is 3 broad bucket of rights you would see in an early stage VC term sheet. And actually, we can start with valuation because, at the end, it is the headliner term. That's when everything starts. Yeah. So what your valuation does is it decides how much of the company are you giving to an investor, how much you are diluting as a founder, right? What is the price at which you are, giving the shares of your company to a new investor? And Vaibhav, you would hear a lot during term sheet stage, right? ESOP becomes one of the most controversial, most discussed topic. Because if a new investor is coming, right, it would ask for an ESOP pool to be carved out. See, there is some logic to that. Just the way industry has developed, right, ESOPs have become a very, very important part of the compensation. So if you want to hire KMPs or, retain talent, you may have to give them ESOP. That's where the VC is coming from. And it's only rational for us to ask that, that ESOP is carved out before we come into the company because we don't want to dilute, right? We have agreed to invest in the company basis a certain percentage. So once you've invested, you would want to see at least that being reflected in the cap table.
Yeah. No, it's very true. So when I remember the first kind of, negotiation that I was doing on a term sheet, I was like, we are paying 4 million for 20% stake in the company. So the founder assumes that, okay, my company's valuation is 20% and I own 80%. And we are like, yeah. And then the first term sheet comes and he's like, I own only 70%. This 10% is ESOP and you guys are owning 20%. Where is this 10%? Why are we not equal, etc., etc. But you're right. We are the first investors to come in and we are paying 4 million for 20%. Immediately later, if you have to dilute out to give it to some other senior hires, it's slightly unfair for us. In the future rounds, whenever more ESOPs will be created, all investors will be diluted, right?
All existing shareholders dilute.
Yeah. It is usually for the first round when we expect that before first institutional check is coming in, you already have an ESOP pool for which the founders have to dilute out.
So typically, like whoever is the institutional investor coming into the new round, so they will have a point of view as to whether it should dilute pre-money or post-money. So if suppose even in a later round there is a new investor coming in, they may want the existing investors to take that dilution and for them not to get diluted, because see, end of the day the new investor also is expecting, or he or she has cleared certain minimum stake in the company and a valuation which is approved by their IC. So immediately after coming in, if they dilute, then their economic rights in a sense is affected and they may need to take a write down, which they wouldn't prefer.
Yeah. Interesting. On economic rights, we've talked about valuations, which I think is the most important part. Then we've talked about this googly that comes, which is the ESOP pool creation. I think the second thing which founders talk about, which has come up in my conversations for economic risk, is this term around liquidation preference, or what we call as Liquef. And it is slightly confusing to understand, and it took me some time to understand as well. Maybe you can talk a little bit about what liquidation preference is, and what are the things that an early stage founder should be wary of. What are the various options that investors have? Why do we even have this in the term sheet?
Sure. So, Vaibhav, typically liquidation preference is something that covers our downside, and liquidation preference is the amount that we get in an exit or liquidation kind of scenario. So, we would as a financial investor typically want a preferred economic or financial right at the time of exit. So, in case we have put in 1x in the company, we would want that 1x to be covered in a downside. So, when I talk about a downside, it is a situation where the exit is not sufficient to cover whatever investment I have made. So, typical investors or Elevation in this instance, we would be happy with something like a 1x liquidation preference, where whatever is the investment amount that we have put in, that is covered in a downside scenario. But there may be more friendly investor terms where there may be situations where a 2x protection or higher than 1x protection is given. So that would be, suppose giving an example, that an investor has put in 4 million in a company and the company tomorrow exits at a valuation or at a level where everyone does not get their capital back. There, if an investor has a 2x liquidation preference, they would, instead of that 4 million, first get 8 million. And then whatever is the rest out of that exit or liquidation event, then is distributed as per the liquidation preference waterfall. So liquidation preference is more a downside coverage scenario.
This Liquef is above debt as well?
So there are some statutory payouts that people have to do, and debt also will be governed by the terms of the debt documents. So as equity holders, we would be after debt is generally the formulation that I've seen.
If the company is doing well, we are anyway above that threshold and it doesn't matter. And usual Liquef in the industry is 1x?
Yes. That's what we have seen in the Indian venture capital industry. So sometimes in bridge rounds or in kind of distress funding scenarios, people insist on different kind of formulations where it's 2x or where we have a full ratchet anti-dilution protection. But at least in the leading VCs as well as Elevation, we have seen that 1x is a pretty standard formulation.
The second thing you're talking about is anti-dilution, which is, I'm guessing, slightly different. So in that situation, the company is not winding up. The company last round, let's say, was at 50 million. And a new round, the company is raising at 40 million. I think that is when anti-dilution clauses kick in. Is that similar to Liquef, or am I understanding it slightly complicated?
So anti-dilution is essentially to prevent the investor getting diluted if a new round happens, where liquidation preference is more at an exit scenario. So you are right in that way. Both are economic rights, but they function differently. Anti-dilution is more when there's a new round which happens, which is a down round to the last round. The anti-dilution kicks in. Whereas the liquidation preference is more to preserve my investment at the time of exit.
And then there are standard clauses for anti-dilution as well, which we have included in the term sheet as well.
So it'll be just a one-liner saying that your CCPS will be entitled to broad-based anti-dilution. But it's not going to be a descriptive clause. So is true for LP. It's a very, very small clause. You just need to read it carefully.
Understood. Yeah, so one thing was around liquidation preferences and anti-dilution. I think the second thing which I remember the founder I was working with come back to me on was guarantee of exit. somewhere we mentioned, and I don't remember the exact line, but we mentioned that the founder has to give us an exit of X and X, and he was very surprised. And I'm sure I remember you guys also spoke with him, and then you calmed him down. But I think for the broader audience, this guarantee of exit and this much has to be given in so and so years. It is very surprising and unnerving. So maybe you can unravel that a little bit for us.
See, it won't be a guarantee. It's more like, see, we are investing in the company, you are running the company, we all need to reach an exit point, at some point in time, be it 5 years, 7 years, right? That's usually what your exit clause would say, that, within 5 years, company will on best efforts basis try to get exit by, so-and-so IPO, start sale, so, and, whatever, different methods. But it's not a guarantee, it's on best efforts basis, right? And I'm sure you hear a lot, right? If it is best efforts, why do you even include it?
Yeah.
See, because there is an expectation setting. We are all working towards an exit within X number of years or Y number of years. You decide in the SHA or in the term sheet, right, who will be the decision-making authority. So you're just aligning on the broad principle. It's not that the investor can go after personal assets of the founder, right? That, hey, you're not giving me, exit. So that's not going to happen. But then, again, best effort doesn't mean that you don't do anything about it.
Yeah.
It means that, we all endeavor to achieve that outcome. If it happens, it's good. If not, your SHA generally would provide for some consequences like drag, etc., to protect value of the investor. But it's not that, you will go after personal assets of the founder.
Right. And just to add to what Shweta said, I think from a venture capital investor, end of the day, we also have a fund life. We have an obligation to return money to our stakeholders. So from that perspective, we need to have some kind of fixed period when the company will start on that exit process. And typically, given that we are a minority financial investor, we don't have access to management or certain key decision making which the management itself must drive. So from that sense, we would expect the founders and the company to cooperate and, as Shweta said, make best efforts for an exit, because they will have to do things like, for example, running road shows, first taking the lead on who should be the merchant bankers who are appointed for the exit. If it's a strategic sale conversation, then engage with whoever is the incoming strategic investor. So all those key decisions are not something we as a minority venture investor can take a decision on. So typically we would require the founders to kind of take the lead on that.
Yeah. I don't think I know of any, instance in the last 10-15 years when an investor would have, taken this to court, that I have not gotten my exit and hence I will do a case or etc. I think it is a term that is there, but I'm guessing it's more friendly between the founder and investor. Very rarely will we see an example of this being implemented per se, right?
Right. Typically, it is something which you have that expectation setting, as Shweta said. If there is some intent issue at either a founder end or the investor end, where it is not either for the company optimal to provide an exit at that point of time, or the company is not providing an exit in spite of the investor having run its course in terms of fund life, etc. There you have some friction. But typically this is something that we need to work together on, because we as investors will also take a lead on helping the company for exit. And also you will find, like typically Vaibhav, in some of our recent companies which have gone in for IPO, they have actively worked with the founders to kind of take those conversations forward, help them with those banker conversations, with conversations with other stakeholders. So this is something that we would do collaboratively, and we would help the founders in this process.
Then on the control part, I think the most important thing is around board composition and control. There are certain clauses related to board composition in itself in the term sheet. Maybe you can start with why these are important, and again why we need to align on the board composition right at the term sheet stage. Again, an early stage founder feels I have to decide what I have to do. You help me, you tell me on WhatsApp. Why do we need a board construct, etc. at so early a stage?
See, it's very important just because of the way law is, right? A lot of important decisions would be taken at board level, and more so in, let's say, US companies, right? So at the end of the day, whoever controls majority of the board controls those decisions. To give you a very, very simple example, imagine for a moment there is no, your investor doesn't have any other vetoes or vote rights on something as important as appointment of a co-founder. Now this is something which will go to board level. Imagine how important this is, right? So you need to understand who is going to make those decisions. Now, see, in early stage deals, usually founders tend to retain majority of the board. works well for both founders and investors, because as a founder, you want to run the company, you want to take some of those decisions quickly, right? You want to be at the helm of affairs. Similarly, for an investor, you are just not investing in the idea or the company. You are investing in the founder, and especially so for an early stage company, right? So you want that founder to be responsible for day-to-day management of the company. And hence, it's important for founders, especially for early stage deals, to retain control at the board level. See, it's having said that, if an investor is actually putting in substantial money, they will ask for board seat. But that doesn't mean that founders lose majority, right? And giving an investor board seat, again, it's good to have a structured board. It keeps, certain checks and balances in place. The game changes entirely when the companies become growth stage, right? As company grows, founders will dilute a lot in terms of board, composition, and the company board will more and more become independently managed, or investors will have majority on those. So having said that, for early stage companies, founders should really look at the board composition, understand what they wanted to look at now, and how it will look and shape as the company grows in future.
And if I can just add on 2 quick points to Shweta's response. So, see, from a governance perspective, I think it's important for the company to develop the right culture. So, in that sense, like while we would typically agree on everything in an amicable manner, it is important to put structures in place, because we have seen this, that with good governance, there is a certain premium also associated, where companies which are well run, have proper governance structures in place, they also, from an attractiveness of investors, they rank highly. And also, just on the board point, I think like there are companies where we may typically not even want a board seat because it is very early stage, but we have seen founders who have come back to us and said that, why don't you, given your experience, some of our partners, some of our teams who have that experience, why don't you come onto the board to guide us in some of these companies? Because like typically the board will also be a place where we can share a very broad overview, or we can share some of the broad structures in mind for the company, some broad ideas. So it would be a very collaborative approach that we would typically follow, where we give you as the company the benefit of our cross-sectoral experience that we have. So from that perspective also, like whether or not we are in the board, I think typically founders and companies want us to give that input which we have.
I agree. No, the question is never about can you help us. I think that everybody respects. It's about the legal aspect of it all, right? Which I think you've explained and made it very clear. Also, one curious question, can we have board composition separate to cap table composition? So for example, if I own 20% of a company, or if Elevation owns 20% in a company, can it have more than 20% in board or less than 20% in board representation as well?
So typically the board follows a numerical threshold. So in that sense, like there is typically 1 or 2 members that you can nominate. So you would have it proportionate is what we have seen. But the board members, as per Indian law, they will have 1 vote per member. So you will not have a person who will have a disproportionate voting right. So you can have certain governance structures where certain items typically need to be approved by the board nominee of the investor, if that is agreed upon. But other than that, you will typically not have a structure where any board member enjoys disproportionate rights.
Understood. And usually in early stage companies, how many board members have you seen, like a seed, series A kind of company?
You may want to keep the board small only at an early stage. So
3-4 people.
Yeah, 3-4.
Out of which 2 are the founders, if there are 2 founders, and then 1 from investor. If there are 2 investors, 1 from each investor.
And 3 from founders, mostly.
2 or 3 from founders, understood.
And typically if the company has like 1 founder, they may want to appoint someone of the key management team who may not be designated as a founder per se, but he or she may want them to be on the board to just have that operational team or management team control the board composition. So we have seen that instance also where there is a single founder, but they want people who are like either industry experts or part of the key management team as part of the founding group board members.
So that they become the numerical majority. Understood. You also briefly mentioned that there might be certain topics which we can make it so that has to be approved by the investor representative, or on which you cannot pass unless and until there is absolute majority or 100% majority or something like that on the board level. Maybe you can touch upon that, because that is also, it seems scary that there are certain decisions of my company which I cannot take unless and until I convince each and every member of the board. Despite having the majority, numerical majority at the board, do I have the company control actually? And what are these, areas, what are these topics, and what is our rationale for doing this? Maybe you can talk about that a little bit.
Sure. So let's understand why AVMs.
So these are called AVMs.
AVM, affirmative vote matters, or vetoes, or protective provisions, in number of names. But why would an investor ask for it? Let's understand that, right? As a VC, you will pick up 15-20% of the company. You are never going to be a majority shareholder in that sense, right? Yeah. So you need certain protections in the company, because you will not have an individual say on a lot of important matters. And that's what the genesis of your AVMs is, right? And see, generally a seasoned investor will not ask on AVMs and on operational things, because that is one argument we keep hearing a lot from founders, right? If I give AVMs on everything, how do I run the company? I may have to wait for 3 business days for me to get a signed AVM letter from you. See, generally it's good for founders to read the list of the AVM matters, right? If they feel something will affect the operations of the company, it's happy to discuss, and if required, you can carve out some of those things, anything which is general operation of the company, because that's not even the investor's intent to, have a veto on everything under the sun, right? You just want to protect some important things. Now to your question, what would be an AVM list generally include? See, it's like a varied list of matters, but it'll have important matters like, co-founder hiring, or major exit decision making, or, let's say disposing of substantial assets of the company. Something which would really affect me as an investor is what I would like to cover as a part of AVMs. And, generally in term sheet stage, it's not that the full list will be discussed and agreed and negotiated. You'll just have a simple line saying that investor or investor majority will have vetoes on certain matters which are then agreed at the documentation stage.
But yeah, it is to ensure that even if we don't have the board majority, we are not exploited.
Correct. Board or shareholder, right? Because even shareholder level, you will never have a majority as a VC. So you want to protect certain important items.
Because then you can be exploited. For example, you can have a co-founder without getting explicit approval from us, which will be tough, right? So we want to be protected of that. Yeah.
And actually, just to add on that, this is more of a practical example, right? A lot of times AVMs come to us for, let's say, venture debts, right? We'll take it to our finance team. They'll look at the document. They'll be like, hey, you can get better deal than that. So it's not just, having a veto on those matters. It's also helping the company on a lot of those matters.
Like taking debt should be an AVM for sure.
Yeah.
Because we can add so much value once that document comes to us that you are taking debt. And if it is not an AVM, maybe the company will take it, will not be even aware of it. And then, makes sense. And on this, governance rights, I think one more clause which even I found scary when I read for the first time was founder vesting, and then something called clawback. Where there was an example which a founder was talking to me about was, if I do some minor error, will all my shares be taken away from me and given to you? I know it is not that way, and I tried explaining him the best, but I think maybe experts like you can explain it to our spectators. What does this founder vesting and clawback mean? Why do we include it? Why it is important, and how it is very different practically than theoretically?
Sure. So I can take a cut at that. So founder vesting is essentially because as investors, we are betting on the future value of the company, right? The company is at a very early stage. The product in some sense has not developed. The team has not developed. So it is a bet on the founder and the idea to a large extent. And whatever valuation we have in our mind, it is assuming that there would be certain continuity, certain growth path, etc. So in that sense, having the founder aligned on a long-term journey with the company or a long-term vision with the company is very important. And with that, you have founder vesting, because today, even though the founder may own 70%, 80% in the company, tomorrow, for whatever reason, if the founder decides that this is not the right thing for me to do, I want to pursue something different, then having a founder in that sense with such a large share in the cap table who's not contributing actively operationally may not be in the best interest of the company. And this we have seen not as an investor protection kind of matter, but this is more in the interest of the company, because for the other co-founders also who are helping build the company, who are getting value made of the company, there is a multiple which is happening with the founder continuity, with the growth of the company. It is not also fair on those other co-founders, other stakeholders who may hold ESOPs in the company, right? Because they have been kind of given those rewards, given those commitments basis a certain continuity that we assume. So in a sense, the founder vesting is more like a earn-out mechanism. So again, we have seen different formulations where people want the shares kept in the escrow till a certain period, etc. But we as Elevation just have it contractually agreed that the founder vesting will kind of take place over a certain period, which typically we follow a 4-year period with a 1-year cliff. And post that, there is alignment that post 3 years, 4 years, there's a certain value which has been built in the company. Then if the founder also wants to exit maybe a part stake, there would be a discussion with the investor, and you would have a agreement at that stage saying that the founder can exit with certain protections like giving us a right of first refusal or a tag right. But before that period, if the founder leaves, then at least we as investors believe, given the criticality of the founder, we should not have an incentive for the founder to leave so early. Now, coming to your second question as to these scary clauses, obviously there are certain events which are defined in the agreements, like what can be a good leaver situation, what can be a bad leaver situation, and these will be clauses which will be negotiated, which the founder's legal team, the founder's advisors, they will advise on. So there may be situations which are, like, again, I would say very one-off, like for example, fraud, embezzlement kind of scenarios, where suppose those kind of scenarios come, we would want there to be certain disincentive built in. But other than that, there are various scenarios where the founder also gets value, where there is an exit, and we don't like have all these negative or punitive clauses in all cases.
Yeah.
So it depends on the severity of the event.
Yeah. I think the broad macro guiding principle that I'm taking away from this conversation is, see, the investors and founders are both working for the company. And the clauses are to ensure that both of us stay in it for the long run.
Right.
And if any one of us has a short-term thinking, that is weeded out right now, right? That both of us incentives are aligned to make the company successful for the long run.
Right.
And if the founder also believes that I'm going to create value in the next 4 or 5 years, then what is the harm in having a vesting period?
Right.
That you get some shares every 1 year, 2 year. If you are of the opinion that you will leave in 2 years, I think that is something that will be cleared out here. If they are negotiating a lot on this vesting, that shows short-term thinking.
Right. Because we are also long-term investors, and we want founders to be committed to that long-term growth, long-term vision of the company.
Yeah. And but are there like exceptions to this? For example, the company has started doing really well in the next year or two instead of the 4-year vesting, and then the founder feels like he wants to buy a house, or he likes a new car, he wants to buy a new car. Can he sell off some of his stake? Like, do we allow for such exceptions? Because I'm guessing we'll not hold it, like we'll not take him to court if he wants to sell something small percentage or something like that, right?
Right. So typically you have these thresholds which are carved out. They are called liquidity thresholds, where there is a certain percentage, maybe a 5% of the founder shareholding at that point of time, which the founders can sell with certain restrictions. We may want, for example, a ROFR, where we as existing investors want the first right to buy those shares. But the kind of understanding is not to deprive a founder of certain value that he may derive with a nominal stake, because like the examples you mentioned are also sometimes seen, but typically there may be other situations also. There may be a medical emergency in some cases where the founder needs certain liquidity. There may be a family situation where the founder needs certain liquidity. So we have always been very supportive of those kind of situations where founders for genuine reasons, founder for genuine needs, we have never hesitated to give those consents.
Yeah. This is to account for the 0.1% bad actors.
Right.
And on amicable terms, if both the parties agree, then it should be easily doable, right?
True.
Yeah, I think these were it from my side on the governance risks and governance part of the term sheet. Anything else that we should cover?
No, I think broadly that covers the majority. Obviously, the full document will have many more clauses which we will negotiate, but I think for the headline term sheet purposes, this provides a good headline understanding.
Perfect. I think now we can come to the third part, which are general clauses and a little minor points, but all the more important. As Shweta keeps mentioning that these are also very important part of the term sheet. I think the first one was around warranties and indemnities. Maybe you can talk a little bit about what are these clauses and again why important to have them in a term sheet.
See, what warranties and indemnities would do is they protect a investor against untrue statements by company or founder, right? See, because at the end of the day, let's say how you would arrive at a valuation, right? You must have seen financials of the company or relied on XYZ document which they gave. You are just relying on them. We may be doing an LDD, FDD, but it's not an investigation, right? We are at the end relying on what company is giving us. So what warranties and indemnities do, they protect you against those untrue statements if something you have relied on, right? Now, generally in term sheet stage, it's not going to be a very descriptive clause, right? It'll just provide the principle. Who will provide reps and warranties? And that's about it. Now, generally, who provides reps and warranties, especially in early stage deals, right? And I know we keep harping on the same thing. We are relying on the founders, not just the company. So that's why you would want reps and warranties and indemnities from both company and founders, right? Because you're backing both. Especially for early stage, you're backing founders more than the company. But having said that, and again, see, these are discussions better taken at documentation stage, but founders can, of course, negotiate things like, that investors should not go after their personal assets, except for something very severe like fraud or something which affects investors' title of shares, right? There are n number of other things which can help a founder or company, right? There could be time caps, there could be monetary caps on indemnity. Those are best to be taken up at the documentation stage, but at the term sheet stage, understand, are you required to give those warranties, indemnities? If you want, maybe you can, try and clarify the personal assets bit. But again, that can also be taken up at the documentation stage. Yeah.
I think the next bit was on exclusivity period. So we usually, when we sign term sheets, we feel like now you are exclusive and you should not go and shop around. It's true for the investors as well as the founders. Is that really binding? And what happens, what is the construct of the exclusivity period in our term sheets?
Sure. So exclusivity period is important because we as investors may have evaluated a lot of companies in that space, and given that we are committing fully as an investment team to that investment, we would want a certain no-shop or exclusivity period. The exclusivity period which we have generally seen ranges between anywhere between 60 to 120 days. So that is essentially the time that you require to conduct a more detailed diligence on the company. So it may be a legal diligence, a tax diligence, financial diligence, business diligence, get more info, do more management meetings. So exclusivity in that sense binds both the investor and the company to that company, and we would then not want the company to engage in parallel negotiations, because end of the day, Vaibhav, we have also as an investor spent time, we have spent effort, we have disregarded maybe some companies which were not fully at that level but somewhere close. So given that background, we would want the company to kind of go ahead with this deal. And typically, we can say that typically we would go ahead with most of the companies that we have signed term sheets with. So it's only rare cases where, as Shweta mentioned, that something in the diligence doesn't work out, where there are other factors that suddenly come into play, that you may have that rare case of not going ahead. But given a normal transaction, you would go ahead, and that is the situation that exclusivity is trying to cover, that the company typically does not shop around taking the term sheet for other deals.
Yeah. All our term sheets have exclusivity clause.
Yes.
I know some funds might give a term sheet with no exclusivity, right? Or nobody does.
So no, typically because the fund is spending time and effort, they would want the company to be bound by those exclusivity clauses. So they would not want.
Understood. I think another question on this part is, should I get somebody else to review the term sheet? Maybe my existing investor. Should I hire lawyers myself? Because this is elevation lawyers, etc. Is another question. I keep, one conversation I keep having with founders is, these are our lawyers. You and I are the same team. We're both working for the company. but they're like, nahi, term sheet ek baar I'll get it reviewed from my existing investors or something. What is your thought process on that?
See, it's not a bad idea. If you have confidence on your existing investors, it's good to run it past them. See, also because they may have some perspective, right? They may be able to guide you. Secondly, most likely they will have certain rights, right? Like they may have a right to participate in this round. They may have a veto on the round itself, right? So you will have to discuss that term sheet with them at some point in time. What is important is, though, make sure that your confidentiality clause provides for it, that you can share the term sheet. Second, and actually that I'll take it after I discuss hiring the lawyer part, it's good to hire a lawyer. Make sure you hire someone who's, well versed in the VC industry and is, who knows what are the market positions. Having said all of this, right, one thing is very, very important at term sheet stage. Time is of essence. So whether you get it reviewed by your existing guy or by your, by your lawyer, make sure you're aligned that we need to, close this draft ASAP.
Continuing on that part, if I have to hire a lawyer for reviewing my term sheet, then expenses will also go up. I'll have to keep paying. And suppose I hire a lawyer and then this transaction does not go through, then all of that is my expense, or will the company take it up, or like the investor take it up?
See, usually the lawyer, a founder or a company would be on their expenses only. Generally, let's say the round doesn't go through, right? You may not have to bear investors' expenses. So that also you need to take a look at the clause, make sure it's clarified. But generally, as a position, EC doesn't ask for reimbursement if, for whatever reason, the round has not gone through.
So
but again, different funds have very different philosophies on that.
But usually the whatever is the expense of closing the transaction is paid for by the company after the transaction is closed.
That's correct.
So the amount that we've paid into their bank account, some of that will be paid back to the whatever is the transaction.
Yeah, but see, because it's unfair, right? They haven't gotten the money. They're looking for investment, and you ask them to pay expenses of the counsel. Yeah.
So I would only caveat that saying that if the company deliberately decides not to go ahead, then there may be a situation where, given that we have spent time and effort and we have engaged counsel with costs, we may want certain portion to be reimbursed. But typically we would only want reimbursement if the closing happens in that case. And think of it, Vaibhav, in a sense that the company tomorrow, like there are again rare examples, but a company has only raised 1 round, 2 rounds, 3 rounds, but they have become a $500 billion company also. So in that lens, like when you are starting off, I know that every penny matters, but given the stakes where some of these poorly negotiated clauses can lead to a lot of disputes, can lead to a lot of later negotiations, it may be helpful in that sense to have a review done so that in the long run, at least that value is protected for both investors and for the founders.
Understood. Very interesting. I think one last question, and the broader guideline which I am taking away from this conversation is, see, if all of us are good actors, and the assumption is that all of us are good actors, right? The investors, the founders, then most of these are not even applicable. It is only for the 0.1% bad actors which might come up at some point of time in the journey, and it's all future, so it's all predictive, because of which we are protecting ourselves through all of these clauses, right? But despite this macro understanding, the term that I keep hearing a little bit here and there is founder-friendly term sheet versus an investor-friendly term sheet. This is the conversation that we've just had. I feel like it is company-friendly, which in turn becomes both beneficial for the founder as well as the investor. But what is your take on this founder-friendly term sheet versus an investor-friendly term sheet, and what are the key differences maybe?
Right. So I would say, see, as you rightly said, we should aim to be company friendly, and as someone had said, that a good negotiation is one where both parties feel that they have lost something. If both parties feel they are winners, probably that's not a good negotiation. Founder friendly or investor friendly, I would use like in the sense that as long as key terms are protected both for the investor and founders, and each of them may have different considerations, it may be founder or investor friendly. The way I would define founder friendly is not have someone with very unusual terms, like for example, few of the terms we mentioned, like a full ratchet anti-dilution, a 2x LP clause, something where kind of, as Vaibhav mentioned, like for minor traffic offenses, we can take away all the shares of the founder. So those are clauses that would not be typical and would be kind of very founder unfriendly in that sense. Investor friendly, see, I wouldn't say that there would be something which is purely investor friendly. If there is a distressed funding, which is again not typically the case in early stage, I would say it is more balanced, but investor friendly in a sense that there may be investors with specific needs, specific requirements, which they want. For example, someone may need certain enhanced information rights because they are a public market investor. They may also be listed abroad where they have certain information requirements. So given that there may be specific requirements of investors which they would want covered and which they may want some mention in the term sheet or in the long docs. But typically a good term sheet, as you said, Vaibhav, would be something which is company friendly and where both parties feel they have won or lost something.
Non investor friendly, I can only think of, a lot of AVMs. Where I have a say, as an investor, I have a say on a lot of things of the company's day-to-day operations to stay in control, which just slows the company down as well, right? So I'm not sure if it is investor friendly in the long run, because if your company slows down, then the investors are anyway going to hurt. So the best term sheet is the one that solves for the company.
True.
I completely agree on that. That was very helpful. So now as a founder, I've understood the various clauses of the term sheet. I've been, as you mentioned, speed is of the essence. I've been very quick. I've got it reviewed. I agree with all of this. And now I've signed the term sheet. What again surprises founders is it might take a long time for cash to hit the bank. What happens after I sign the term sheet and before cash hits the bank, and why does that process take so long?
It's a long way from term sheet execution to funding, Vaibhav. See, because a lot of things happen after you sign the term sheet, right? And again, it really depends from fund to fund. But like for us, we will kick off a lot of things in parallel, like your LDD, your FDD, your documentation drafting and negotiation, all of this just starts in parallel, right? And the more complex the company's business is, the more regulated it is, the more older the company is, that much time your LDD and FDD are going to take. So typically we see something between 60 to 120 days. Now for funding, now the time period really depends, right? Because once you've signed the docs, there are certain things you need to do, CPs. So some of those may be, things which have come out from the LDD which you need to fix prior to the round. Then even otherwise, the way the law is, there are a certain set of actions that a company will need to do before it can issue shares and, get that money in the account. That usually takes a couple of days for company to complete post the execution of the document. See, sometimes the companies are so new, and actually a lot of times you will give term sheet, the company name will not be there, right? So it takes time for all of those things also, to set up your company bank account, to incorporate the company XYZ. So I think at least a minimum period of 60 days is what I've seen for a VC, funding to close. And it can increase to any number of days.
But this would be considerably shorter for follow-on rounds, etc.
Yes, follow-ons are generally quick because you've already done most likely a diligence on the company. You're just topping it up, similar for FDD. But for a first-time investment, you need to look at it everything from scratch, right? And like I said, if the company is regulated, it's going to take more time.
And mostly these delays are also, and for the, to get myself clear with the founders, these delays are usually more admin related, right? Because you have to pass a clause in the board level, you have to file some secretarial documents, you have to file certain documents with the government. More often than not, it is those processes, admin processes, rather than anything else. Right?
Yeah, so a major part of it, like you rightly said, is admin process. But generally, and you would also notice, right, deals have become very complex. The amount of negotiation both parties would do, it's increased quite a bit actually, especially post-COVID, right? So that itself has increased the time. So, the time is a factor of a lot of things. If everything keeps increasing, the overall time increases quite a bit.
But in your experience, 60 days is a good enough time period to expect.
That's the minimum actually.
Yeah, that's the minimum. And just to add to what Shweta said, there may be events or actions that arise out of the due diligences that are more beneficial for the company to correct at this stage where it is still fresh and there are advisors involved, rather than later on where the company just and founders want to just get on with the business, move on with it. Because typically we have seen in our experience that once money hits the bank, the founder wants to go running in terms of running the business and not spend time on compliances, etc. So to get all these things remedied, this is sometimes the best time, that when the documents are still getting negotiated, you have pointed out certain non-compliances in the diligence. So that getting resolved or fixed helps the company also in the long run, in the next round or later on.
Yeah, which is why most founders want institutional funding, right? Because when we say we come in and resolve the processes, this is one of those things that we do, right? We ensure that the company is structurally built enough for the long run.
Because surprisingly, like we have seen very mature stage companies, also companies going in for listing, having some basic non-compliances, and sometimes like these can have very serious consequences where the entire listing may get delayed, the valuation may get lost. So some of these smaller non-compliances sometimes seem very trivial, that it is more paperwork, admin work, Vaibhav, as you said, but the consequences of some of these can kind of bite you later on. So better to get these resolved.
No, makes sense. Thank you so much, Ram and Shweta, for taking out the time. I know you guys are really busy, but you took out the time to help educate some of the young founders who might be listening. So thank you so much for that.
Thanks, Vaibhav.
It was a pleasure being on the show.
Thank you. That wraps up today's episode where we are talking about term sheets. Hoping this was helpful for you, and see you all in the next episode.